Many of you have been asking, how do I invest in the Nairobi Securities Exchange? If you're thinking about investing in the Nairobi Securities Exchange or any other exchange in the world, that is a very smart move. But don't go in blindly. Welcome to Sophie's Chronicles and welcome to our series From Hustle to Hammock. Today we discuss risks that are inherent in the securities exchange. The first risk I would like to discuss is a market risk, or what we call the systemic risk. This is a risk that will affect all counters. This mainly happens when there's inflation, when there's political instability, or when there's an economic downturn. During the 2020 pandemic and 2022 national election, the Nairobi Stock Exchange experienced a decline in all the counters. So what is it that you need to do to avoid the market risk? One of the mitigation factors is to diversify your portfolio. Ensure that you invest across all the asset classes, from treasury bonds, treasury bills, money market fund, equity fund, so that you mitigate against such kind of a loss. The other advice I would like to give is that focus on the defensive sectors. These is sectors that are able to hold value during economic downturns, like the telecommunication industry, food industry. Those will hold value even when the country is in crisis. The other advice I would like to give is that focus on long-term investment. Remember that markets recover over time. The other risk I would like to talk about is the business risk, and this is a risk associated with a company or an industry. This is due to poor operational efficiencies, poor governance, and poor management systems. How do you protect yourself against business risk? Research the company thoroughly, check the financial statements, check the operational efficiencies, and check their business model. That will give you a hint on where to invest your money. The other way you mitigate against the business risk is to ensure that you invest across the sectors. I've always said invest in the banking sector, in the energy sector, in the telecommunication sector. Just ensure your eggs are not in one basket. Avoid companies that have persistent losses, those that have very high debt ratio. The third risk that you should be concerned about as an investor is the liquidity risk. This is when, as an investor, you cannot be able to dispose your shares at a fair price because the companies you have invested in have very low trading volumes. You should avoid those companies unless you are a long-term investor, because the time you want to liquidate your money very fast, those companies will not have enough volumes to trade at the Nairobi Securities Exchange. How do you mitigate against liquidity risk? Ensure that you invest in the highly traded counters like Equity, Safaricom, Absa, KCB, among others. Avoid investing in the small companies unless you're doing it for the long term. Check the trading volumes regularly. Ensure that you have a stockbroker that you consistently consult with.